All right, welcome to the intro to risk management video. Let's dive right into it. So, why do we use a lot size calculator versus straight lot sizes? Well, the simple explanation is, if you understand how a lot size calculator works, say we have a position we want to enter with a 2 pip stop loss, and say that we enter with 20 lots, right? Say it's a long position, right? Similar to this. Say that, we have a 2 pip stop loss, and we want to enter. That's probably representative of probably 0.5% risk on a 100K account, right? Now, say that we then see another setup, but we want to cover the low a little bit better because maybe there's a candle below that's unmitigated, and we just want to be a little bit safe about it, right? Now, if we were to widen our stop loss by another 2 pips, so we have a 4 pip stop loss now for that next position, and we're still entering with 20 lots, we're now basically risking double, right? So you can kind of see the issue here. Our risk then becomes inconsistent between the different positions that we're entering, right? So with a lot size calculator, what's the difference? We're actually risking a percentage of our overall account balance. And on top of that, like obviously it scales up and down depending on the actual size of your account. Whether you're on a 200K account, you're on a $1,000 account, whatever it is, you're risking, an actual calculated percentage of the overall account balance versus an arbitrary lot size or dollar amount, right? So this helps for a couple of reasons. Again, we'll go over it in more detail in the following videos, but obviously I also wanted to talk a little bit about the different types of lot size calculators. There's the the MyFX book one, or I think there's even lot size calculators on as an app version on people's phones. I've used them before in the past, but when I started my forex trading journey, I very quickly switched to using a lot size calculator for this very reason. I understood, okay, there's compounding interest, not interest, but rather you can compound your account, with a steady equity curve, and we can actually kind of like compound our gains in a sense, right, by risking, 0.5%, so, or whatever percent you want to risk, right? So we can take, a 100K account that, say we've scaled it up now to 110,000, right? We're up 10%. We can then continue to risk, every time we're going to risk fixed percent of that new balance in the account, right? And that is how we're scaling up, because we're risking the total, pie, right? We're risking a percent of the total pie versus just, a fixed amount every time, right? So it is pretty powerful in the long run if you compound stuff. But in terms of actual lot size calculators, I personally use Magic Keys now. I have the hardware and software version. I started out with using position size calculator. That's an actual screenshot of like my terminal that I used to use, just as an example. And then we have Trade Assistant, which is I think available for MT4, MT5. So I mean, there's tons of options. There's people in the team that use Trade Assistant. There's people in the community that use it, that vouch for it. I've never used it personally, but I still recommend it over the MyFX book lot size calculator, which is great. But here's the problem with that one. The reason I have it X'd out is because if it's going to take you 30 to 60 seconds to enter a trade after you see like a setup that fits your plan, literally that can mean like the life or death of that particular position, because sometimes if a trade is going to set up, it's going to take off within the next candle. You're not going to have time to enter it, right? So we want to reduce the execution in time from the time that you see a setup that fits within your plan to you actually executing it. You should be able to enter it as you please without having to actually like think about it or enter values into a calculator, have it spit out a certain lot size, and then you fiddle around with your stop loss and stuff like that, right? So that's one way to think about it. In terms of compatibility with different platforms, like I said, Magic Keys, it works with every platform that's out there, so I really like it. But the thing is, I think CTrader actually has its own built-in calculator too, so that's pretty good. All right, moving on. Why shouldn't we risk more than 1% per trade? Well, it's a matter of account durability and minimizing our risk of ruin, right? Our total loss risk. So the problem with risking over 1% per trade is we can actually get ourselves into situations where we run into drawdowns that are both psychologically and mathematically very difficult to recover from, right? So we don't want to put ourselves in this position where we're in like a 20% drawdown, or maybe we're even like close to a 10% drawdown on a funded prop firm account, right? We want to manage our risk in the sense that we want to give buffer for losing streaks, because they are inevitable, they are going to happen. it's better that we are well equipped to deal with them by using a proper risk profile, right? So we recommend risking anywhere from 0.25% to 0.5%. 0.5% is the most common. I wouldn't even really recommend risking 1% at the start. If you're going through this course for the first time, even the second time, right? Personally, I even continue to use 0.5%. I don't risk 1% because, as you saw from my equity curve, I hit pretty big losing streaks sometimes. So it's fine, right? It's within my system, not a big deal. I think 0.5% is a good healthy balance because at least you have like a good amount of exposure. You'll be able to pull a decent amount of actual percentage, right? Also representative of your R, right? R is really just a multiple of the percent risk per trade, right? So that's why we always measure things in R, because every team member's risk per trade, even every member's risk per trade in Phantom is pretty variable, right? But I'm hoping that you guys are all sticking to a fixed percent risk per trade, right? We'll talk about that in a little bit more detail, but we don't want to be risking more than 1% per trade. If I'm risking 2% for trade, for example, right, on a prop firm account, just imagine, right? All it takes is 5 losses in a row to make me hit the total or like the max drawdown of 10%, right? That's on average what it is for most of these prop firms. So why would I do that when, instead I do 1%, which would be 10, roughly 10, right? Or if I do 0.5%, it'd be roughly like 21 trades, right? Something like that. Because remember, we're also scaling down our risk a little bit. Remember, we're playing the long game. We're not here to gamble our funds. Risk management is number one. High risk to reward is not the name of the game, right? High risk and high reward. You can have a high risk to reward ratio on a trade. There's nothing wrong with that. I hope you guys catch trades like that. It's like the most fun type of trade to catch, right? So we want to have a healthy and conservative risk profile and healthy and consistent returns, right? And that would be represented in our equity curve as a smooth line that's going up. Maybe we have drawdowns, not a big deal, but we always recover from it and make new equity highs, right? All right, now let's look at some examples of trading systems. In this orange box here, we have 1% risk per trade over a series of 30 trades. By the way, these are all simulated 100 times. So imagine, you test this over 100 times. This way we have some sort of statistical reliability between the tests, right? It's not just like one instance of us getting lucky and, hitting literally 100%, right? Our maximal performance, but on average, right, over 100 tests, this is what we can see the average total loss risk is, right? So we want a lot of data to sort of back it. It's not just an outlier, it's actually concrete and backed by data, right? So moving back to that, what's our average RR, right? Our R is plus 5R with a 30% win rate, and our max drawdown is 10%. Imagine these are all prop firm accounts, okay? Obviously, if you hit 10% on a prop firm account, an actual drawdown of 10%, you're blowing the account. It means you lose access to your funding, right? So with this one, you can actually see our total loss risk is 3%. And this may seem like a low number, but this is actually, considered pretty high, right? We want to keep this as close to zero as possible, right? Because then we have, a lower risk of kind of losing the account, right? Now, in terms of our actual performance and stuff, it's not bad, right? 26%. This could be representative of, a month of trading, right? If we're trading on average, 1 trade per day. Maybe on some days we take 2, on some days we don't take any trades at all, right? But now let's look over here at this red box, right? And there's a reason I marked it red. We're risking 2% per trade, right? I was just talking about this on the previous slide. Why don't we want to risk 2% per trade? Look at the total loss risk here. Our risk of ruin is 23%. You literally have almost a 1 in 4 chance of blowing the account, risking this much, right? Why? Because, if we start, at the very start here, all it takes is 5 losses in a row to take us to negative 10%, right? In account equity, right? If we're risking 2% per trade. That's not really good odds, right? Now, if we contrast this with, a couple of healthy risk management systems where we're risking 0.5% risk per trade, same parameters and everything, right? 30 trades, 5R P&L ratio, 30% win rate. This is actually kind of similar to mine, except I have a lower win rate, right, of 25%. Look at the total loss risk, 0.1%, right? So this is pretty good. This is one that I would want to aim for, right? It's a pretty average plus R. Our win rate is, manageable. You're basically winning essentially a little under 1 in 3 trades, right? And again, our max drawdown is the same, 10% because it's a prop firm account. But look, our average performance is not bad, right? 14% a month on 0.5% risk. Like, that's pretty good, right? That's pretty much what I've done the past 2 months, right? About 30%, 28% between the last 2 months, right? Our maximal performance, again, this is really an outlier, and same with the minimal performance. But look, we're nowhere near blowing the account, right? Look, a minus 3.5% drawdown, 7R drawdown, right? Based on 0.5% risk. That's recoverable. It's not a big deal, right? Now let's look at this one over here. Again, very similar, but now I've done it over a series of 100 trades. So we have even more data to back it. Remember, every line here is representative of one simulation, right? Again, it's probabilistic. So our equity curve is never going to be exactly the same, but we can pretty much deduce that on average, right, our total loss risk is still going to be 0.1%. And over a series of 100 trades, we can expect that we'll probably get a 50% gain, right? At minimum, maybe 5.9%. At maximum, 112%. But again, these are outliers, right? Again, on average, we're going to fall within this range, right? So again, why are we doing simulations? Because we want data to back these, right? I'm not just pulling this out of my butt, like I said before. Why would I do that, right? It makes more sense to have data behind it to actually support what we're talking about here, right? And if you understand these, then you'll very likely pick a trading system like this. This is what I started out with, and I still sort of trade this. I mean, it hasn't really changed. All that's changed is my win rate's gone up a little bit from what it used to be. Actually, it's gone down overall from what it used to be, but my RR has gone up a little bit to compensate for that. So I still think my total loss risk is probably hovering in and around the 1 to 0.1% risk, or risk of ruin. But obviously we want to try and get that as close to zero as possible. If you can get it to 0.0001, that's perfect, right? A lot of it is reliant on our trade psychology and stuff, but let's go into that a little bit, right? Now, in terms of back testing and demo trading, so why do we want to treat it like a live account? We don't want to take trades that we wouldn't take in a live environment. Why? Because if we're going around taking random trades just because it looks good, again, we're going to develop a bad habit of taking stuff that's outside of our plan. Again, I've done this before, right? So that's why I'm mentioning it. We only want to take setups that are prime and within our plan, right? So it's okay to rewind and reverse engineer trades in simulation, or when you're doing like your daily recaps, if they're prime setups in hindsight. It's really good to go and cut price back, do your markups, let price play forward, and really understand and reverse engineer why a particular setup worked, right? Take your prime setups. If your setup results in a loss, you eat the loss. There's nothing wrong with it. You can't avoid taking losses, even valid losses, right? There's nothing wrong with taking them, right? This is a really, really important thing to remember when we're practicing. Even when we trade in the live market with a live account, it's even more important there, right? Because if we can't take a loss to the chin, it's going to affect how we execute on the next trade. Either we're going to be fearful, or on the flip side, we're going to revenge trade, right? Which is even more dangerous, right? They're both dangerous, but it's, that's probably the hardest skill, is to develop the confidence to continue hitting trades, even if we're losing, right? Because, the trade's always, or the next winning trade is probably going to be around the corner, so long as you are consistent in your execution, right? Just remember that. So exercise the same patience and discipline that you would in demo as you would in live, right? And same with sim trading. You don't want to blast through all the price action in a couple minutes. You want to blast through like days of price action like that. Take your time, reverse engineer price, understand what's going on. If you take a loss, that's fine. Try to understand it. If you take wins, try to understand it, right? You want to reverse engineer everything. Nothing wrong with it. Take your time. And last but not least, remember, document your trades, fill out your journal. Practice executing your trades to build confidence and consistency, right? Again, there's a reason why we constantly tell you guys, do your daily recaps, right? It's because that's where you learn, right? That's probably the best tool for learning. I think backtesting is great, but it has a lot of drawbacks too, right? You can develop bad habits with it. At least with doing recaps and hindsight markups, we can take the time to process what price was doing and actually recognize our setups, annotate it, and understand why we would have got in where we got in, right? And then when we see that type of setup in the live market, we'll execute on it because it fits within our plan and we're used to it, right? We've built the skill to recognize that particular pattern and when to get in, right? Oh, that's super important. Now let's quickly talk about a little bit different risk management systems, right? So again, with these ones, we've simulated it now over 100 different times, right? Now with this one's a little different. I wanted to talk about high win rate systems and relatively lower RR type systems, right? So imagine on average we're winning plus 1R. Now with this one, look, plus 1R, 50% win rate. I mean, we're pretty flat on here, right? It's not great. Our total loss risk is actually pretty high at 6%. But if we look to the right now, if on average now we still have that 50% win rate, which is pretty good, by the way. This is kind of more representative of retail based strategies, to be honest with you guys. But look, imagine we're winning 2R and 50% win rate. Look, our total loss risk has now shrunk to 0.1%. That's amazing, right? But I mean, you have to have a relatively high win rate, but to make 2R on a trade, I mean, you could trade the way that we trade supply and demand at Phantom this way. You honestly could. I don't really see anybody doing it because I feel like people kind of have, this propensity to try and like trade high R. But listen, you could trade it that way if you wanted to. I don't expect you guys to, and I personally don't. I like capturing moves that are going to move a little bit. But on average, a lot of my trades, even personally, they don't go all that far, right? Like I like taking my 7R, 10R, 14R, maybe at max 20R trades, right? And I like closing them intraday. And I don't have to stress about it. It's not a big deal, right? And then I compound my account as I continue to hit those trades, right? And they help to absorb all the losses that I take, right? When I hit losing streaks too. Moving on, if we're looking at 2R versus 5R minimum setups, right? At a 30% win rate. Now let's look at the difference. Again, simulated over 100 different times, right? 100 different equity curves. Look, 2R trades on average, right? That's what we can expect to win on our setups. Maybe we have a hard TP, but our win rate's only 30%. 32% risk of ruin. That's pretty high. This is not a system we want to be trading, right? Now we contrast this to same thing. Remember, we're risking 0.5% per trade for the last 4 equity curve simulations that I've shown you guys, right? What's our average RR? 5R, 30% win rate. Again, I think this is the first one that I showed, actually, that I recommended to you guys. Look, again, total loss risk, 0.1% risk. This is what I found to be the most balanced one. This gives you the room to take losses. That's why I recommend it, right? And to get a 5R trade is not all that difficult with the system that we trade, right? Even if you set like a hard TP at 5R, it's something you could do, right? Maybe if you're starting out, it's worth testing, right? But I don't think we really recommend doing that anymore. Either way, 30% win rate, listen, it's manageable. It's higher than what mine is now, but remember, my average R, what I'm eating on an actual winning trade is on average higher than this, right? So it makes up for it. Nothing wrong with that. Now, here is a conservative beginner's risk system. It's a buffer builder, right? These are honestly good for if you've just gotten funded in an account and you want to build buffer in an account, and then maybe you want to push your risk up to 0.5% risk per trade. It's not bad. It's the same sort of parameters, but look, our total loss risk is 0.1% still, right? That's our risk of ruin. You can see our average performance is 14%. It's not bad. If we're trading over a period of 3 months with this, right? Just on average 30 trades per month. That's representative of about 5% per month, right? So that's not bad. Not bad at all. I mean, I would take that. I'd invest my money in that, right? Especially with a low total loss risk, right? I would personally invest in a trader that does that. Now, I'm not saying that to have you guys bombard me with DMs or anything, but I'm just saying theoretically, right? Now, if we look at an aggressive system for flipping buffer and profits and stuff, again, listen, I really want to give you guys a warning with this. This is not for beginners. I don't even do this myself. I know some of the traders on the team do it, and I think it's fantastic, which is why I'm including it in here. I think it's something that's worth noting. But look, it's a 1% risk per trade system, average of 5R, right? Our win rate, 35%, right? It requires a little bit of a higher win rate. And look, our total loss risk is still 1%, which is not great. But listen, if you're just using this to flip profits that you've made with a 0.5% risk per trade system or 0.25% risk per trade system similar to this, I don't think there's much of a problem with it. But again, requires a different type of trading psychology. Again, you have to honestly have a lot of experience to execute this kind of thing properly, right? So if you're new, do not do this. But if you are super experienced and you've been with Phantom since day one and you're consistent and all of that, go ahead, try it. Maybe try it in sim and demo first, see how it goes, right? But yeah, that kind of concludes this section or this video. Let's move on to the next one. I'll see you guys there.